Elfreda Jonker. I'm the Client Portfolio Manager at Alphinity Investment Management. Today I'm joined by Mary Manning, one of the portfolio managers on our global funds. And Mary has recently been to China as well as Hong Kong for a fantastic trip. And today we will be reflecting on some of her key thoughts around that. So Mary, as a starting point, can you tell us where you've been and what some of the broader themes are that you would like to flag?
Yeah, thank you, Elfreda. So I went to China and I hadn't been there since 2019. So usually for most of my career, I've gone to China twice a year at least. And so it was very weird to go back after like a long hiatus of not being on the ground. So I went to China, and then I also went to a China summit in Hong Kong and met with a lot of companies there. So in terms of my overall takeaways, I'd say one is, there's been sort of a thematic out there that Hong Kong is on the demise and Singapore is on the rise. And that's not really my takeaway at all. Hong Kong felt like it was back, COVID was over, it was very busy. There's still a lot of activity there. So I think that, market share gain of Singapore is maybe overplayed a little bit. The second thing is that there's no going back on COVID. So I took the train to China, and you did have to fill out a health form. But other than that, there's lots of infections in China, and things are totally back to normal. So there's no threat at all that China's going to go back into some sort of lockdown. There's been a complete mental shift in terms of what COVID is. Great news, exactly. And then the last thing I'll highlight was the conference in particular was quite bearish. And for me, I think the bearish part came out in terms of the longer term trajectory of China's growth. Because for those of us who have been covering Chinese market for a long time, over a decade ago, it used to be growing at 10%, and then the new normal was like 8%, and then it was aiming at 6%, and then their current GDP forecast is for 5%. And speaking to some of the economists, the forecast going forward for the next decade is somewhere between 3 and 4%. And a China growing at, say, 3.5% is very different than a China that was growing at 10%. And it has a lot of implications, certainly for Australia, for commodities, for the property market, for consumption. There's just a lot of things that flow from that lower trajectory of GDP growth. So that was one of my main takeaways on the macro front.
Yeah, quite a scary expectation and a reset there. So if we focus a bit more on the sort of shorter term, and one of the key themes in global equities have been the China reopening, and how do you position for that? What is your main takeaway after visiting a lot of the companies and speaking to management on the ground around the reopening, and how have we been positioned for it to date?
So most countries in the world have reopened, right? And so I think a lot of investors, including us, when it became clear that China was reopening, we all said, oh, we've seen this movie before. We've seen it, dozens of times before.
Yes.
And one of my big takeaways from China is that actually it's a different movie, and that there are very different implications for consumer sentiment and consumer confidence if you've been locked down for 3 or 4 months versus if you've been locked down for 3 or 4 years. And a number of the companies that I talked to, management said there's like a psychological scarring effect that happens when you're locked down for that long, which we didn't see in other countries. The second thing that's quite different about China is during COVID, lots of other stuff went on because it was so long. So you had the whole regulatory reset in the technology sector, which was partially responsible for the unemployment rate going up. You had a whole sort of decimation is too strong a word, but the property market really came off. And you've had a lot of things change within the economy also. So it's not going to be like the US or Australia reopening where you had a nice V-shaped recovery and it was, a big bounce off the bottom. It's going to be more gradual, and that's fine. I think as long as companies and investors have that expectation, China is definitely reopening. There's no doubt in my mind that reopening is happening, but it's not a V-shaped reopening like we've seen elsewhere. In terms of the companies that we have exposure to, LVMH is probably one of them that has the most direct impact from China reopening, because when you're locked down, you sort of have less demand for looking nice and wearing these luxury goods. So that's one. L'Oreal is another. So that's along the same veins as LVMH. And then lastly, Starbucks. Starbucks is a company that we just bought into last year. And part of the thesis was around China reopening, because there was at one point last year when a third of Starbucks China's stores were closed, and that was like literally just a very negative impact on their operating profit. And as soon as those stores open, just as long as they're open and selling any coffee at all, that's a turnaround for the OP. So Starbucks, L'Oreal, and LVMH would be our three investments indirectly in the China reopening.
Yeah, that's interesting, and also very reflective of what some of the other global portfolio managers have said from their read-through speaking to companies on their travels of late in the US as well as Europe. So Mary, lastly, let's focus a little bit on the luxury sector. So you've mentioned LVMH. It's been a fantastic story for us and one of the biggest stocks in our portfolio for many months. What is your outlook on the luxury sector overall from here? And any changes to that positioning that we've had of late?
So I did kick a lot of tires in the luxury sector while I was there. I went to over 25 luxury stores in both Hong Kong and China, and I mean, it's better than going to a mine site or a factory, but it was quite overwhelming in terms of like just the attachment that there is to these luxury goods and the desire to buy them. So in terms of our positioning, as you mentioned at the beginning, luxury has been a fantastic sector for 2 years now. And part of the reason behind that is it's sort of been a rolling investment thesis. So there's always a reason to hang on to it or to invest in it if you don't own it. So at first it was reopening in the US and Europe. And then it turned into an inflation play because having a price-insensitive consumer or end customer is very helpful in an inflationary environment. And then it turned into China reopening. So as a result, the luxury sector is a known as a good investment, and the sector can be quite crowded. So one of my conclusions is that from here, it's not just buy luxury because it's a good sector. You're going to have to be very good at stock picking. So that's why I went to all these different stores to actually look at what are the products, what is the marketing campaign, what is the target customer, and just really dig deeper down into the stocks and the brands and the products, not just luxury is good as a sector. So after all that work though, my conclusion is that LVMH is definitely still the best one to own, probably because it has the best brand portfolio. It's across luxury, fashion and leather goods. It's across wine and spirits. It has other businesses. It has alcohol business. So, definitely the most diversified portfolio. It's very reasonably valued and has an extremely strong management team. And some of the individual brands like Dior are doing extremely well. So still like LVMH. And then there's some stocks which are kind of like stay away. Prada would be one of those. That was not a very good meeting. There's kind of a single brand and they have some succession issues and it's relatively expensive. And then one that I have my eye on is Kering. So Kering is the company that owns Gucci, and Gucci as a brand has been in a bit of trouble, but they have a new designer and they're trying to turn that around. So as you all know, Alphinity, we need that earnings leadership and earnings to turn around. That may be coming. So that's one that I have my eye on.
Fantastic, very interesting. And if you want to learn more about Mary's travels overseas and her views particularly on the luxury sector, she's done a fantastic note. So visit our website on alphinity.com.au. Thank you.
Thank you.